Welcome to Express Notes for ACCA Paper F9 on Financial Management. Today we want to begin with an overview about what financial management is all about. Now we could say that the CFO of a company should be concerned about attracting the financial resources necessary for a company to be able to fulfill its corporate objectives. The usefulness here, starting with the big picture, is to place ourselves in the company, in the financial management function, and to say what or how should the efforts in financial management be synchronized or coordinated with the objectives of the rest of the corporation. To answer that question, we need to know what the overall objectives and strategy of the company is, and then that basically is your, in a sense, you could look at that as being your independent variable, and therefore the dependent variable will be finding the right solution in terms of financing solutions to achieve the chosen corporate strategy. That's the big picture. Now, of course, when we get into the guts of this subject, then we're going to be looking at a number of concepts and tools and disciplines and ways of actually performing financial management functions, whether it's discounting of cash flows to choose investment projects, whether it's determining what the right capital structure should be, the relationship between debt and equity, and so on. All those questions have to be answered, and they are critical parts of the CFO's mission in a company. Okay, so aligning and defining the financial strategy in accordance with the overall corporate strategy, that's the big picture. Of course, we know that the management of a company should be seeking to maximize shareholder value. So shareholders are, of course, an important focal point of our concern, especially if you're looking at the US and the UK. In continental Europe, the concern is not quite fixated on shareholders exclusively, but then again we could say that in the US and the UK nothing is 100% or 0%. We don't want to go to extremes here. We have to understand that all company managements, while they have to serve the shareholders if they're a profit-making business, also have to take into account the interests of stakeholders in general. Now, we know very well from earlier papers who the stakeholders are, and in no particular order here, except to have mentioned the shareholders at the top of the list, we could say that stakeholders come in many shapes and sizes. We have the employees in a company, we have the people who manage the company, senior executives and so on. Those are internal stakeholders, if you want to look at it that way. Then you have your category of so-called connected stakeholders. That's kind of the next ring of parties who have an interest in the company and some sort of stake in the company. That's where the word comes from. To have a stake in something means to have an interest in something. Those would be people who lend to the company, people who buy from the company. Customers, very important stakeholder group. Of course, suppliers. We want to think about suppliers being interested in the welfare of their customer, who is the company itself. They want to have long-term beneficial supplier relationships because they're looking for repeat business. And then, of course, if we move to the outer ring of external stakeholders, there we would be talking about such entities as the government itself. They, of course, have two main interests. One is to receive revenue through corporate taxation. And the other interest that they have, of course, is the employment generation by private sector companies, so that good, sustainable jobs is very important from the government's perspective, because it makes for a happy electorate and hopefully more votes at the next election. The public in general is a stakeholder group in itself, people who form opinions about companies. They read the newspapers, they follow the news, and therefore they have also a decisive, or can have a decisive influence. Think about this. From the general public, you have potential shareholders, for example. So a company wants to appeal to the general public. It's also looking at potential buyers of their shares. But it goes beyond that. We can take certain sections of the public and we can divide it up into, for example, public interest groups. So people, subsets of the public that are organized in so-called public interest groups or non-governmental organizations, or even more specifically, environmental lobby groups and things like this. These are all sections of the general public who have various either organized or less organized structured interests in what a particular company is doing. And I think it's safe to say that a company, the management will ignore the public sentiment or the actions and positions of public interest groups at its own peril. In other words, it's very unwise to disregard the public sentiment with regard to a company, because that's what helps influence the image and the reputation of the company. So I think it should be clear that a wise company management, corporate management, should be looking at stakeholders and understanding where the stakeholders are coming from, and base its actions, the company should base its decisions and actions on an understanding of what likely reactions will be among stakeholders. Now, of course, stakeholders can disagree with one another, so we speak of conflicting stakeholder interests. What we did on the previous page was merely basically a laundry list of the different stakeholder groups, but in a more dynamic way, we could examine the way in which different stakeholder groups have possibly conflicting or opposing interests to one another. One obvious one would be employees who want to have higher wages, and management which wants to keep the wage bills down because they want to have lower costs, because they want to see higher profits. And in this way we could say that management and shareholders have a common interest. Take another group, for example, customers. Customers like to have long store openings. When I go to the supermarket, for example, I'd like to be able to shop there at nighttime, 8 o'clock, 9 o'clock in the evening. Of course, from an employee's point of view, the employee would like to close the doors at 5 o'clock or 6 o'clock and go home. Of course, now shops are organized in shifts so that they can keep longer store hours in order to serve customers. But at the beginning, the initial discussions in terms of extending working hours was not always met favorably by the employees. So in this way, we could say the employees and the customers can have different points of view and interests. We could even say that among employees themselves, there can be different subsections that are opposed to one another. Take, for example, a few years ago, major airline, which experienced some tough negotiations with the cabin crews. This is the flight attendants of this particular airline. They were threatening to strike for higher wages and better working conditions. Now, in that particular case, the cabin crew, and that does not include the cockpit crew. The cockpit crew means the pilot and co-pilot and so on. But the cabin crew was threatening to strike, but the cockpit, the pilots and co-pilots, they are organized as a separate association. They were against such action. And now you see different parts of the employee groups disagreeing with one another. Then, of course, another major concern from a corporate governance point of view is the natural conflict, or let us say divergence in interests that can happen between management and shareholders, and this we refer to as the agency theory. Now, agency theory is premised on the notion that shareholders are principals in a company. In other words, they are beneficiaries of the company's success, whereas management are acting as agents of the principals. Management is acting in the best interests of shareholders, or they should work in the best interests of shareholders. But do they always? Well, that's not guaranteed. Management will often make decisions that will be self-serving, that will serve their own interests and not necessarily in the best interests of shareholders. You see some examples here. Now, how do shareholders who are not around to supervise the company on a daily basis make sure that management behave themselves? So influencing management behavior, an important part of this paper, is to understand how remuneration packages would be formed so as to incentivize management behavior to be consistent with the interests of shareholders. Important concept, we just mentioned it here. What this paper seeks to do, of course, is to come up with particular performance measures that can reliably show whether shareholder value is being increased or not. Without going into great details, of course, since this first chapter is just an overview chapter, let's just look at some of the typical performance measures that are used commonly in companies. One is the return on investment, or also known as the return on capital employed. This is extracting accounting numbers, financial accounting profit before interest and taxes, and dividing it by the capital employed. Capital employed, of course, is defined as your total assets minus your current liabilities. Or another way of defining it is your non-current assets plus your working capital. There's even a third way to define the same thing, and that would be your long-term liabilities, let's call it long-term debt, plus your equity in the business. Now, as we will discuss in the paper, the ROCE has certain disadvantages connected to it. First and foremost, because it is based on accounting measures, therefore there's a depreciation is included in the profit before interest and taxes. And also, as the assets of a company are depreciated over time, it automatically leads to an improvement of the ROI or ROCE measures. So we need to understand not only how things are defined, but also what their advantages and disadvantages are. EPS is another typical measure used typically by investors, earnings per share, and of course return on equity is another one which is typically mentioned in annual reports and reporting by company management. One last point we need to make clear in this paper, and that is financial management, while it's directed towards increasing shareholder wealth for a profit-making company, we can also apply many of the techniques and financial management concepts here for not-for-profit or non-profit organizations. And so please keep in mind the applications here that will be relevant to not-for-profits. Thank you, and looking forward to next time.